Welcome to this short and crisp webinar. You are going to get crystal clear clarity in this very short duration, and that's my assurance. Before we get into the presentation, let me just take a couple of minutes to introduce myself. I am CA Nrajca, Chartered Accountant by qualification, a teacher, trainer by passion. I started my career in banking industry through State Bank of India, joined as credit analyst, in short period elevated as team leader, credit processing, had opportunity to work on 250 plus projects, it's 5,000 crore plus size. After 4 years of stint in State Bank of India, I moved to CA practice, had my practice for 7.5 years, parallelly took teaching assignments, started teaching financial management, strategic financial management for CA, CMA and CA students. I'm also an empanel trainer with leading private sector bank for training their executives on financial analysis, working capital and project finance. Thanks to technology, today I teach 2 lakh plus students all over the world through my structured online courses, and it's because of the same technology you are also attending this mini webinar now. One more thing, if you don't have your notepad and pen, please pause the screen, go and take notepad and pen because you are going to have many key points to make note of in this session. Let's get into the presentation. In this session, I'll introduce what is indifference point. Okay. In the previous sessions, we have talked about capital structure mixes. Then we have also taken some case studies. But what you got to understand is you can have a different capital structure. Say for example, let's say you are going to try capital structure 1 where you will go only with equity. Let's say you are going to try capital structure 2, okay, where you will have debt. Let's say you are going to try capital structure 3 where you are going to try preference share capital. So you can try different capital structures. But what is indifference point is, indifference point will tell you at a particular level of EBIT, you will become indifferent to either of this capital structure. Okay, so at a particular level of EBIT, you will become indifferent to capital structure 1 and capital structure 2, or at a particular level of EBIT, you will become indifferent to capital structure 2 or 3, or at a particular level of EBIT, you will become indifferent to capital structure 1 and 3. So what I'm saying is, indifference point is basically a level of earnings before interest and taxes where you become indifferent to the given capital structure. That means you can either go for 1 or 2, or you can go for 2 or 3, or you can go for 1 or 3 at a given combination. So how this indifference point works? Let me show that. This indifference point is basically calculated using a mathematical approach. That is, first I'll try to find out what is going to be my earnings per share at a particular capital structure. So I'll call it as capital structure 1. So I take earnings before interest and tax. Let me do a small modification in my pen. Please permit me. Yeah. Let me just increase the thickness. Okay, fine. So from this earnings before interest and tax, I have to subtract my interest, and this is the interest on my capital structure 1, so I'll call it as EBIT minus 1. So this is the profit before taxes, okay, and on this I have to pay tax. So in order to find the profit after tax, what I'll do, I'll multiply 1 minus T. So this is my profit before tax. 1 minus T will tell me what is profit after tax. Then I'll divide it by number of equity shares in option 1. That is my capital structure option 1. Okay. Now let me just reduce the size. Okay. So this is my capital structure 1. In my capital structure 1, this is my profit after tax. This is my number of equity shares. So this is nothing but earnings available for equity shareholders. This is nothing but earnings available for equity shareholders, and this is nothing but number of equity shares. Earnings available for equity shareholders divided by number of equity shares. This is nothing but earnings per share. Okay, so I'm going to find out what is the earnings per share in option 1. That is my funding option 1. At indifference point, what will happen? my EPS in option 1 will be exactly equal to EPS in option 2. So what will happen there is, in the second option also, whatever EPS I get, that will be very much equal to EPS what I got in option 1. It means at indifference point, you will have this position. That is, your EPS in option 1 is going to be equal to EPS in option 2. How it will be? Let's say EBIT minus interest in option 2 multiplied by 1 minus T divided by E2. So here I2 represents interest in option 2, T represents tax rate, E2 represents number of equity shares. So if you notice here, what you are going to derive here is nothing but EPS in option 1. And this EPS in option 1 will be equal to EPS in option 2. So this is your indifference point. What happens in indifference point? Your EPS in option 1 becomes equal to EPS in option 2. So let whatever be the capital structure, whether you go for option 1 or you go for option 2, it is immaterial for you, because in both cases your EPS is same, and the ultimate objective of capital structure is maximizing EPS, and here what you are getting is in both the scenarios EPS are same, so you actually become indifferent. So when this indifference point will work is, if your actual EBIT is exactly equal to indifference point, okay, that is, if your actual EBIT is exactly equal to indifference point, then you remain indifferent to your capital structure, let it be 1 or 2. But in reality, it will not be the case. In reality, it will not be the case. Your actual EBIT can be greater than indifference point, or it can be lesser than indifference point. So that's where you actually make effective use of indifference point analysis. So in reality, what happens is, let me just add a page. Yeah, in reality, what will happen is your actual EBIT can be greater than indifference point, or your actual EBIT can be lesser than indifference point. Okay, so it can be lesser than indifference point. So you have to take a call. If your actual EBIT is greater than indifference point, then you have to see in which capital structure you will have EPS going up. Okay, because your actual is greater than indifference point. At your indifference point, both the capital structure will give you same EPS. So if actual is greater than indifference point, then in which capital structure your EPS is getting maximized, that you should understand. Similarly, if your actual EBIT is lesser than indifference point, again you have to see in which capital structure EPS would get maximized. Okay, so if you can understand, if you can get control of this, you can make best use of indifference point in capital structuring. We'll take one case study to understand how it works. Thank you so much. We have come to the end of this mini webinar, and I am sure you would have derived much value from this short and crisp webinar. In my opinion, what you have seen is only the tip of the iceberg. There are several other interconnected topics which you have to learn in order to achieve excellence and mastery. So if you wish to continue this learning journey in a more organized and structured way, I have an amazing opportunity for you. I have published a series of comprehensive courses in financial domain, each costing rupees 2000, but I'm going to give it to you at a special offer price today. Here we go, Finance and Accounting Mastery Bundle. In this bundle, I'm going to give you a series of courses. To start with, we have Financial Management, a complete study. In this course, you will be learning financial management in depth. Topics like basics of financial management, time value of money, financial analysis like ratios, cash flows, fund flows, cost of capital, capital structuring, capital budgeting, NPV, IRR, everything discussed in depth in this course. Then we have course number 2. Advanced Financial Management. It's a comprehensive course and you will learn various advanced concepts like advanced capital budgeting techniques, risk analysis, sensitivity, derivatives, leasing, forex management, portfolio management,
dividend decision, mergers, acquisition, several miscellaneous topics, and securitization, security analysis, valuation. Next, we have course number 3, Accounting Basics, a complete study. This course will give you solid foundation in basics of accounting. You will learn basics of accounting, technical terms in accounting, double entry system, journalizing process, final accounts, everything in depth, a comprehensive ever course. Then we have course number 4, Advanced Accounting, a complete study. In this course, various advanced topics in accounting are discussed and covered. Just have a look at the screen for the topics, exhaustive topics that are covered in this course. Then we have course number 5, that is Cost Accounting, a complete study. In this course, you will learn various topics related to cost accounting. You have topics starting from basics of costing till ABC costing. So overall, 5 courses, each course priced 1,999. The overall value is close to 10,000 rupees. It's 500 plus lectures, and what you get is lifetime access to all these pre-recorded courses. You can access them in mobile app and desktop. All this is going to cost you close to 10,000, but today you can enroll for just 2,499. It's not yet over. I'm going to give you something more. You are also going to get access to various bonus resources, basically ebooks. So it is overall value close to 10,000 rupees, 15 ebooks of value close to 1,500. You are going to get lifetime access to all these courses and e-resources.